So, to sum up, the past 4 decades, globalization fueled long-term interest rates falling. Falling long-term interest rates begot more globalization. The offshoring of manufacturing reduced costs and created massive inflows to China. Those massive inflows had to go somewhere and eventually led to Chinese industrial overcapacity, as well as a bunch of useless investments, as I read to you. That Chinese overcapacity created a supply glut, particularly in resources, that kept producer prices low as they exported deflation back to the West. And that labor dividend that I've talked so much about starting in the early 90s helped keep wage growth down. All of these dynamics have seemingly exhausted their shelf lives at the exact same time. Now, a global secular regime shift to an era of higher baseline volatility for costs, growth, and thus interest rates is likely ahead of us. Many may not acknowledge the turn until much later, stuck waiting for a return to their version of normal. Memories are short, and recency bias is powerful. Everyone's waiting on the return to normal. Everyone assumes the Fed will cut. They'll cut rates all the way back down to zero, just like they have every time before. They'll cut them below zero. They're going to go all the way back down because rates have to keep falling, right? Just like these guys thought. Rates just have to keep falling because they've been falling for decades. No one anticipated any change. But the bond bull market had already ended, and over the following decade, Treasury yields rose. That was 120 years ago. So I think it will be really difficult for us if this dynamic is true. I think it'll be really difficult for interest rates to keep going down, which is what has been the rescue mechanism for the central bank every time we've had a crisis and they needed to spur new growth. They just lowered rates even further than they were before. They reduced the cost of financing below what it was before, so everything was cheaper. They can't do that anymore. We hit zero. It doesn't get any cheaper than this. So if interest rates have gone all the way down and hit the zero bound, even if the next 10 years look like this, let's say we don't turn around and start going higher on interest rates. If it's just we came down and maybe we're just like this for a while. Maybe they go up, they come back down, they go up, they come back down. This dynamic is necessarily different from the one we just left. It's necessarily different from this one, where interest rates were able to continually go lower and provide a boost to financing costs. The same way that we've been talking about this dynamic here. This is zero. We can't go below here like we have all the times before, right? Rates went below here, went below the low. 1990 recession, tightening cycle, cuts below the low. Cuts GFC below the previous low, below the Greenspan 1% low from 2003. There is no lower than zero, not in the US, not for the reserve asset. So if this dynamic has changed, if rates have come down, hit a wall, and they just necessarily have to be more volatile because all of these other dynamics have changed, that is a world that no one is really positioned for. It's a world that no one alive today really has any experience dealing with because they can't imagine it because it hasn't existed before in their lifetimes, right? Like I was born up here. Like 82, 83, this window. This is where I came into the world. I have only known falling interest rates, secular falling interest rates, secularly increasing globalization and trade cooperation. If you think that any of those things are changing, then the markets will change. Correlations will change. The relationships between interest rates and the markets will change. And I think that we're going through that period now. This fall in interest rates, it created so many other sub-dynamics of risk-taking, of asset allocation, of portfolio construction. All of those things were built in this era. And all of those things will necessarily have to be recalibrated to whatever the future is going to look like.